Welcome back to Switzer on Australia's business channel. Pengana Australian Equities Fund has been one of the best performers over a long time, and Rhett Kessler is the fund manager responsible. And so I'm dying to pick his brain on how he wants to make money this year. Rhett, thanks for joining us on the program.
Good to be here, Peter.
Quickly tell us about Pengana, the history.
Okay, Pengana was started in 2002. A guy called Russell Pillimer and Malcolm Turnbull. Malcolm sold
I
out.
thought Malcolm was there.
Malcolm sold out to NAB. They've been very successful in launching 5 different funds. My fund is one of them. They've got a unique business model in that we're actually partners in the business. So I own half the partnership of the business.
So your money's on the line too.
My money's in the line, and my money's in the fund as well.
Yeah.
And so we don't try to beat the market, typically all the funds. What we try to do is preserve capital and make a decent return.
Okay, so does that mean certain stocks you won't touch?
Well, certain stocks where we can't predict what they're going to do or how we're going to preserve capital, or their business models are just too opaque, we stay away from.
Yeah.
So resources are difficult for us. We've tried really hard to predict the iron ore price and the oil price and the coal price.
Yeah.
Frankly, I think most people can't do it, but we certainly can't.
Yeah.
So we don't play.
And it must irritate you at times, like for example when you see BHP at 30 you think this has been sold off the map and it looks like good value at 30, but it doesn't suit your model, so you just won't play it.
Yeah, we looked at it. We looked at it really hard, and we thought that possibly there was a level where we didn't have to predict the iron ore price, but being as conservative as we did, it didn't quite get down to that level. So we quite disciplined. We stayed away. And
it also started to look like a reasonable dividend play at those levels as well, didn't it?
And given what I think is coming as well, where
dividends,
you know the resource companies are realising that they've got to look after their shareholders. They didn't pay dividends during the biggest super cycle ever. So when are they going to pay dividends? I think it's coming.
Yeah. Okay, so tell us about then the kinds of stocks that end up being in your fund. Give us classic stocks that are in your fund.
So we have a phrase which is we like to buy toilet paper and toothpaste type companies, where A, we can understand the businesses, B, we can predict them with reasonable certainty. Then they must have good management who are competent in their core areas that are needed for the business and not trying to build empires for themselves, but happy to part with the cash. And then thirdly, but probably most importantly, it has to be at the right price. Don't ever confuse a great business run by great management on the one hand with a good investment on the other. Because if you pay too much, you're going to be the last guy to the party.
Okay. Are you therefore often seen at your best when the market's really dropping and people are running for the doors, dropping good businesses, and you see good businesses at really low prices?
Possibly not when it's dropping. Nobody enjoys that.
No.
And we've been in that situation.
Yeah.
But I think we're at our best when we have the discipline to see through the sentiment and find real value. And let's face it, the cheaper things are, the more value there is, and the easier it is to spot. So that's typically when we do best, coming out of those periods.
Do you worry when something looked transparent but ended up not being transparent? And the company I'm thinking about was QBE, and maybe I was wrong in saying it looked transparent. Maybe to someone who works on a daily basis drilling in the companies, you might have come to the conclusion QBE wasn't transparent. But for a long time there, Frank and QBE could not make a mistake and pay good dividends, and the share price rose.
It's the way we think about that. I mean, you're right to bring up QBE. We often use it as an example. Great business, run by very competent people. The problem is that from the outside, you never knew for every dollar you put in what you were actually buying. So I'll juxtapose that with, for instance, Tattersalls. You know very clearly that 2/3 of every dollar, so 66 cents, you're buying a lottery business, 1/3 you're buying a wagering business. You know where you have to look. QBE, you just don't know unless you're the internal actuary.
Yeah, and I think a lot of people got very surprised. I think they backed Frank in those days, so QBE grew on the strength of what he was doing, but it certainly has surprised a lot of people.
But don't get me wrong, I don't know if it was a good business or not. It's just from the outside we didn't know.
Yeah. Okay, so tell us about the kind of companies you really do like now.
Okay, the ones we really like now, some of them are out of favour, some of them are in favour. But the two that spring to mind immediately, one is ResMed. ResMed is a global medical device provider specialising in sleep apnea, although they're rolling out a lot of other products. It's had 75 consecutive periods of growth. and we think they've barely scratched their market. It's a bit under the whip at the moment because instead of having double-digit growth, it only had high single-digit growth. It's got a cash box that we think makes the CFO a trifle lazy because he doesn't have to worry about debt, and he has to worry about where to put the money.
Yep.
So they've got lots of net cash. Economically insensitive, so we don't have to predict the economic cycle. Well diversified geographically, so we don't have to worry about currency that much. And at a reasonable price.
Why is it being clobbered now?
There's a presumption that it may be going ex-growth because of a couple of tough quarters. We think mid-single-digit growth in their core business with lots of ancillary second horizon businesses is fine for us, particularly at this price. But the short is there's never been a bigger short position on the stock, and we like that.
Okay. What else do you like?
There's another one that's, I suppose, really out of favour, and that's Old Media, 7 West Media. The Nine Roadshow, when they floated, I guess trumpeted the strengths that Nine has to potentially the detriment of 7. We don't think so, but that's okay. If you can buy a well-run business in a, I think, a structurally sound industry, TV, not newspapers and magazines, which make up a very small part of its business, on a 10 times earnings, and the way we think about that is a 10% after-tax cash earnings yield. At the bottom of the advertising cycle in TV, we think that's a good bet.
Okay. Now, what about banks? Banks have been a fantastic investment for a lot of my viewers, self-managed super fund people. Okay. So where do you move on banks? Do you still play them a little bit, or you just smile because you bought them at good prices and the yield's fantastic?
Probably 2 areas. I mean, we hold 2 of the banks. We think they're great businesses in an oligopoly.
Can you tell me what 2?
Yes, sure. We own ANZ and NAB.
Okay.
And the reasons we own those is, A, because we think they're good businesses with resilient business models at the right price and well run. The reason why we hold those 2 is NAB has got the biggest business bank, and as a result we think things are improving at the business end, and particularly given that home loans have full price discovery, so everyone knows what the home loans are at every bank, whereas business lending is a lot more opaque, and therefore the companies have more power, or the banks providing those. So we've got high hopes for the NAB business division. I think management took on a very difficult job with turning NAB around, and I think the early signs are there that they've done a good job. ANZ's probably a little more complicated. Their core businesses, both for NAB and all the other banks and ANZ, are the home loan mortgage book and the business book. But ANZ offers quite an interesting fillip in terms of their trade finance business. Uses very little equity and highly profitable, and I think they're growing that niche at quite a rapid rate.
Rhett, unfortunately we're out of time, but I tell you what, I've enjoyed talking to you. I hope you come back on the show.
Oh, thank you very much. Nice to be here.
Cheers, mate. After the break, the export of education is now a critical part of the Aussie economy. But what do we need to do to ensure we don't get left behind in this increasingly competitive space?